This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. The Wealth Roundup for the week of March 6th, 2026. I'm Terry Evans with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Good morning, Patrick.
Good morning, Terry.
It's been a couple of weeks since we spoke because of a vacation situation, and we are back now, and there is no shortage of things to talk about, specifically as we record this on March the 3rd. The market took a big drop today, I'm guessing because of things happening worldwide, military things and all of that. But let's look specifically at the market maybe and give an update as to what's been going on over the last couple of weeks.
Yeah, coming off the weekend, markets sold down sharply yesterday morning, but actually recovered by the end of the day. That perhaps provided a little bit of false sense of hope that the markets weren't going to have a general risk-off trade, which we saw today, obviously with the Dow dropping about 1,000 points. I guess in the context of what does this actually look like with investors that are perhaps wondering what the impact of to their investment accounts are. If we look at the S&P 500, it would be down about almost 1.7% today. TSX, which is actually a very energy heavy index, and of course we all know we know oil prices are up, but the energy heavy TSX down almost 3% today. Gold down 4%, which is perhaps a little bit kind of counterintuitive when you have a geopolitical risk like this. Down 4%, but still trading over $5,100 US. Bitcoin, it's been flat for the week. Long bonds. I think this is kind of another thing that we kind of talk about bonds about once every 3 or 4 weeks. We kind of do it only once every 3 or 4 weeks because it's kind of boring. But bonds are, in my view, a very important tool to kind of forecast what the market's longer term outlook is to any type of event. And for the most part, longer term bonds remain unchanged. If we look at fixed income products less than a year, perhaps a little bit of a rise in prices, which means a little bit less in yield. That is also being compounded by the fact that the US dollar has kind of bucked its recent trend and the US dollar has popped up. That would be a classic flight to safety trade. And then when we look at oil, so up 8% today. So West Texas Intermediate just under 77 when I recorded this morning, probably closer to 78 right now. And when we look at Western Canadian Select, almost to $59, so up $10 since our last call. But the differential has widened. The differential now is around $18, and you might recall 2 weeks ago we were around 14. We really want to see that differential closer to 11. Thinking back to at the beginning of the year when we were talking about our 2026 forecasts, we kind of talked about all of the risks that remain in the market, and we talked about the potential for a geopolitical risk. We certainly didn't call this particular event, but this would certainly be one of those things. We also indicated that we don't necessarily plan for geopolitical risk when we're managing investments, and I often say that the best strategy when one of these type of events occurs is to always be ready for a geopolitical risk before it happens. So to have your portfolio properly allocated for your timelines and your risk tolerance. And so, in context, if we look at, say, what a growth portfolio how that would have been impacted, because of these particular market events, is that a client who's perhaps 20% in bonds and 80% in equities would be kind of a classic growth allocation. They are probably 2 to 2.5% off of their high point for their portfolio value, but probably on a year-to-date basis, they're probably still 2.5 to 3% to the positive side because the markets have had a pretty good start to the year. So I think the expectation is this is not going to be over shortly, and so I think investors should expect that we're probably going to see more risk off trade, and then longer term, because we're talking about probably the impacts to energy are going to be maybe what people are really going to focus on. Oil prices going up, is that from a strategy perspective, is that longer term, we're going to look to go and see what the impact is on inflation. Energy gets incorporated into almost everything when it comes to an expense or a cost. And so with inflation, we also want to be thoughtful of what might now happen with interest rate strategy, because our expectation was in the US, inflation would be in check and they would have the ability to lower rates, later this year.
Okay, so that's kind of morphing into what I was going to ask next. Obviously, the geopolitical event happening in the Middle East right now with Iran. How is the impact different, the economic impact from an international standpoint compared to how it affects us on a Canadian standpoint? Is there parallels? Is there huge differences? What is something that we should be looking for? I'm just making sure that people aren't running out of the building like their hair is on fire because of the volatility of their investments.
Yeah.
Maybe depending on the risk level that they're at.
Yeah. Yeah. So it's a great question. So certainly a couple weeks ago, we talked about the psychology of investing. So being just very mindful of the headlines and just making sure that clients are fact checking to see how actual world events are impacting them. For example, the Nasdaq, somewhat kind of unrelated to perhaps these events, whereas the S&P 500, the Canadian markets are maybe 3% off their highs. An investor who would be 100% in technology stocks. Say if we look at the Nasdaq, the Nasdaq is negative on a year-to-date basis. Again, thinking of specifically what investors own may not be what the media is talking about, with regards to what's happening with your investment portfolio. So knowing what you own, knowing why you own it, and knowing what the impacts are, I would say that at this point, and like I said, I think that this probably has the potential to get worse before it gets better. For the most part, the impact for a Canadian investor who owns large cap stocks and also owns some fixed income and is very diversified, maybe between Canadian stocks and US stocks and international stocks, the impact is at this level probably relatively insignificant, whereas a very concentrated portfolio would be more impacted. I also think that investors, that have more of their capital in, say, emerging markets are probably more impacted because they are more susceptible to shocks in the price of oil. If we think of Iran's exports of oil specifically, Iran is responsible for about 3% of global supply. The Strait of Hormuz, which of course is very focused on right now because it's closed, is very important because approximately 20% of the global supply of oil travels through that strait. And so with that strait being closed, obviously this is why oil futures are rising. Now, most of Iran's specific supply goes to China. So this is where you'd look at something like strategic reserves and say, what are the alternatives if all of a sudden oil supplies specific to a specific country are constrained? We're very fortunate here in North America that we're largely net exporters of oil. So if anything, probably in the short to medium term, you could argue that there might be some benefits to a higher price for oil, and that some of that supply shock may carry later into the year, hopefully when this particular event becomes less volatile, which I think is the hope. But of course, hope is not a great investment strategy. But we would look at similar type of events in the past and say, this might be something that affects us for a quarter or two. But maybe some of the longer lasting impacts is that oil prices remain higher than they were or elevated for the remainder of the year and perhaps maybe even carrying into 2027.
So something like that, how it affects the economy internationally and then nationally, it also trickles down to provincially. And we just had the Alberta budget come through, and everyone talks about Alberta's dependency on oil and how it's going to affect the budget provincially. And do you have a budget review, so to speak, that you
Yeah.
can tell us about?
Yeah. So I think the big headline with the Alberta budget is that Alberta is going to run a fairly sizable deficit for 2026, 2027, $9.4 billion. And so it seems like there's budget deficits everywhere. you know, is that you've got them federally, you've got them provincially, you've got them on a municipal level. And so, when you look at the average debt that a Canadian carries, other than just their Mastercard, is they have a whole bunch of other things that are getting heaped into their wheelbarrow. In the commentary in regards to the deficit, one of the things that was highlighted by the economic minister was that low price of oil. And so we would, run a projection, and if we were projecting that the price of oil, say, just looking at WTI, was going to stay in that range of around $60 to $65 a barrel, that would be certainly one of the main reasons why government revenues would be reduced, and therefore budgets deficits would be higher. Now, if that oil price were to stay higher for longer, then theoretically that budget deficit should not be as high. And so certainly something to watch. And even as we were starting to analyze the budget here at BMO Capital Markets, is that we could kind of see that oil prices were starting to edge up even before the weekend. So part of that budget was there was going to be some extra spending. And so the province was going to be looking for some extra revenue. So we see a tax hike increase for property taxes, specifically for education in both Edmonton and Calgary. So Calgary, it's going to be about an average increase of about $340 per homeowner increase. Edmonton, about an extra $154 per homeowner. Also a new vehicle rental tax. So, the province is really looking for places to go and find, extra kind of user fees to raise some money. A tourism levy. So an increase, about 5%. Also fee hikes at your local registries for things like driver's licenses and historic site admission fees. Now, on the spending side, so where's this money going to be going? We're going to see about an extra 7.2% increase to education funding. So, we were talking about education earlier in the year when Alberta teachers were on strike. So certainly there's some money being thrown at that problem. And then also a bump in healthcare spending, just under 6%. So when we look at that and then we say, okay, running deficits, but also seeing some spending, and with deficits, that means that there's some borrowing, is that all of these things are just like your average household. We review and then project what the impact is going to be on the short-term and long-term growth of the province. And so normally we would say if we've got 2% growth for Alberta or above, then that's closer to trend. If we're less than 2%, then that would be below trend. So we actually expect at least for this year, is that for Alberta GDP to remain slightly above that 2% limit before it contracts next year. So really what we're thinking is a lot of this extra spending is really it's going to not truly be felt until next year. And so next year, a slight contraction before a recovery back to those 2+ GDP growth rates by 2028. So yeah, I think the key takeaways are oil prices continue to be important. There's more spending. I think Albertans would be happy to see potentially where that spending is going. Healthcare and education are obviously hot topics, but that the net result of that additional deficit spending is not overly significant, and in fact might be completely absorbed if oil prices remain higher.
Nothing in the budget about common sense or living within their means or operating their business like a sensible business person?
Only if it's in small print, Terry. Only if it's in small print.
I didn't see it either.
Yeah.
All right. For wealth management and to start your investment journey, you can find Patrick's contact information, www.patrickmleonard.com. And of course, if you're watching this on YouTube, please subscribe and share and hit that review if whatever the button is on YouTube. That wraps up the Wealth Roundup for the week of March 6th with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.